You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
In addition to our sponsors, we'd like to highlight our media partners who play an important role in keeping the options community informed and engaged. Thank you to Black Knight, including Asset Servicing Times and Security Finance Times, FIA, John Lothian News, and the Options Insider Radio Network. Please visit the media partners link in the top navigation to learn more about their activities. Up next is our Day 2 keynote presentation with the Honorable Randal Quarles, the Vice Chair for Supervision for the Board of Governors of the Federal Reserve System. It's our pleasure to welcome him to the program. He'll be interviewed by OCC's Executive Chairman, Craig Donohue, where they'll discuss the Federal Reserve's current initiatives and priorities.
Well, it's my pleasure to introduce today's keynote speaker, Federal Reserve Chair for Supervision, Randy Quarles. Governor Quarles has been a member of the Federal Reserve Board since 2017, and importantly, also serves as chair of the Financial Stability Board. Prior to his appointment to the board, Vice Chairman Quarles founded and managed an investment firm following previous stints in both the public and the private sector. Vice Chairman Quarles, we're delighted to have you with us today. Thank you so much for joining us.
It's a pleasure to be here. Thanks for having me.
So obviously this year's pandemic last year has stretched all of us in so many ways. And as I think you're well aware, the options industry saw record volumes throughout the year. And I'd like to just take a moment to say that, we're very proud of the fact that, we processed all of that volume through our various exchanges and market participants and clearinghouses like OCC extremely smoothly. We really are glad that we were able to do that, given all the resiliency enhancements that we have undertaken with the support and cooperation and encouragement of our regulators and supervisors, including the Fed. But we all also had to deal with many unexpected challenges like working from home and yet, handling those kinds of volumes. I'd like to get your view on some of the positives that you observed about the functioning of the financial markets during the pandemic, and what are some of the lessons learned going forward, do you think?
Well, I think you're absolutely right that there's a lot to be proud of. The options industry, the financial sector generally, in the way that the stress from last year was handled. It was, obviously it was an unprecedented stress. I mean, you had an unprecedented dash for cash with levels of uncertainty that were higher really even than they were in the financial crisis of 2008, because people really didn't know what the other side of the measures to essentially shut down the economy for some period in light of the outbreak of the virus would mean. And certainly, as that process was beginning, I would have expected there to be some significant operational glitches, some significant failures, not systemic failures probably, but some significant failures of process in that. And there were very few, really none, of a material nature. So the financial infrastructure handled that incredible demand placed on it very well. And then, as you noted, it did that in a context where virtually everyone on a moment's notice had been told they weren't doing this from the environment in which they had prepared to be able to handle something like that, but from their living rooms. So there's a lot of positives in that response. I think there are, obviously, I think there were probably some bullets dodged. While it was about the most severe stress imaginable, not everything that one could imagine happening did happen, and it's probably a good idea for the various parts of the financial sector to think through. All right, we did that very well. We get an A, but to get an A plus, there probably were some things that might have happened that didn't happen. We were lucky didn't happen. Let's take advantage of doing the thought experiment of what if this had happened? Would we have been prepared for that? And address some liquidity risk management issues, some other operational issues, general financial stability points. But I think, as you say, the industry has a lot to be proud of. There was a lot of positives.
Well, thank you. Speaking of bullets dodged, an important recent initiative from the Fed and other banking regulators has been the transition from the current exposure method to SACR. And I know that you know from our meetings over the last couple of years that this was a very important issue for our industry in terms of, the capital burdens of clearing member firms, given the current exposure method versus SACR. I want to first take the opportunity to really thank you for your leadership on that issue. The concern was always that the capital intensity required by CEM could have the potential to really affect liquidity during times of market stress. And so it was great to see banking regulators acted on that. So thank you for that. But I'd like to get your current perspective on that. It's been some time now, and I know it's difficult to generalize, but are you seeing the expected results that you hoped for in allowing people to begin transitioning to SACR?
Well, as you all know, SACR doesn't become mandatory for the largest firms until the beginning of next year. So it's probably a little early to stand on the deck of the aircraft carrier and announce mission accomplished, or to draw a lot of conclusions from actual data that's coming in. But we remain, we remain very persuaded that the SACR model is a superior model. It's more risk sensitive. It doesn't treat exposures as a percentage of a fixed notional amount. It takes greater account of collateralization and the quality of collateralization. And I think all of those are areas where, although the data hasn't come in because it hasn't become a mandatory framework yet, we're confident that we will be seeing the benefits from that we expect to see.
Good. That's great. Are there other areas of capital regulation that you believe may be ripe for consideration or adjustment?
Probably, yeah. So, I mean, it's not anything new. It's been on the table for a while, but there are elements of the whole Basel III capital framework that were agreed that haven't yet been implemented, and that we are committed to complete the implementation of. I'd like to get our proposal for finishing them out this year. There's a whole lot of moving parts to getting that done, but I think it's doable. And there we're talking about, again, as your participants certainly know, a capital charge for operational risk, some refinements to the general credit risk capital framework, capital charges for capital framework for market risk, that the international framework has been discussed, but the specifics of how the Fed would propose to implement that have not been put out, and so we do intend to put those out. Obviously, anything that we do would be put out for comment, and there's the typical administrative procedure back and forth. But those are some unfinished matters from the general Basel III framework that remain to be done, and that we do intend to get done.
All right, thank you. You also recently gave some remarks on the importance of stress testing, in which you noted the refinement of stress testing has greatly enhanced the credibility of our capital adequacy framework. And there certainly has been a continued evolution and enhanced focus on stress testing, particularly for organizations like OCC, who have been designated as systemically important. For those in our audience who may not have seen your remarks, I wonder if you could share your perspective on the importance and the impact of stress testing as a tool for regulators.
Sure. I think that the stress testing framework, an additional benefit of the stress testing framework was really thrown into relief during the events of last year. So we have, for several years now, as everyone knows, been using the regular annual stress tests as a mechanism for ensuring banks' capital resiliency in a steady state, essentially. And with refinements that we made last year, we actually further adjusted the stress test so that it actually sets the capital requirements for the largest banks. There are minimum capital requirements that are the same for all banks, and then for the largest banks that are subject to stress test, the stress test defines what we call a stress capital buffer. That's very granularly risk sensitive to the risks of particular institutions, and that's the last bit of the capital stack that the largest firms have to reach. So people are familiar with that, but the origin of stress testing, as everyone will remember, was in the 2008-2009 financial crisis, and the running of a stress test during the period of stress itself to evaluate the resilience of the firms during that moment, as opposed to a tool to set their capital requirements. It was a little too late to close the barn door at that point, and the question was simply providing analysis to policymakers and confidence to the public that the firms had capital, what the capital position of the firms were. And last year, we used the stress tests in the same way during the evolution of what I call the COVID event, because it was a combination of the pandemic and the government response, and all of that resulted in the pressures that the financial system was facing. And I think that our ability to use that stress test in that way, and our decision to use the stress test in that way, put the United States and our financial system in a better position than, with hindsight, we can look back at the decisions that were made in other jurisdictions and some of the decisions that followed on from there. They decided not to run stress tests during the crisis. They said, look, the stress test is designed to ensure that banks have enough capital. That's not the question now. We've got to get through the crisis, so we're not going to run a stress test. And as a consequence, we don't have a granular insight into the current position of the firms. And so we're going to require them to completely suspend all capital distributions. That wasn't a crazy decision to make at the time, but we went a different way. We said that we think that our stress test to us and to the public about how the firms are managing through this time that will allow us to make more analytically grounded decisions, particularly about what to do on capital distributions. And so we suspended share repurchases, but we allowed dividends to continue, which was not done in most of the rest of the world. Obvious, and we were able to do that because of the stress testing practices that we had developed over a decade. I think now, we can look back over the course of last year and say that was a better decision in general for our system. It was a better decision for the ultimate cost of capital in the financial system. It conveyed confidence at the time in our financial sector, which was important to maintain. It was something that we could say was, again, analytically and data-based as opposed to sort of reacting on our gut. I feel pretty happy, again, with how we used the stress test during that period, and I think they can be used in the future to provide similarly data-based as opposed to reaction-based decisions in a time of stress.
Agreed. Vice Chairman Quarles, you have so much on your plate. It's amazing to know what you are doing. But I mentioned earlier that you also serve as the chair of the Financial Stability Board. And I wonder if you could share with our audience what are some of the top priorities that the FSB has for this year.
So the FSB does have a pretty crowded agenda. I think it goes back to maybe your initial question about you asked what were some of the positives of the response, but also what were some of the lessons learned. And the FSB has been spending a lot of time on lessons learned from the COVID event and the reaction of the financial sector to the COVID event. Which has given us a pretty active agenda this year. Towards the end of last year, end of the fall, the FSB published a holistic review of the March turmoil that describes, in general, our sense of what happened and where the stresses were. And that has highlighted, a number of areas for particular focus. The first one, again, as I expect most of your participants here know, is a focus on money market funds and money market fund resilience. I think that that's one of the lessons learned from the crisis, is that we still have some work to do there. There were some changes made to money market fund regulation after the 2008-2009 financial crisis. And it turns out they didn't really work as intended during March of 2020. So I think there's a need to look more closely. We're doing that at the FSB. The President's Working Group in the United States at the end of last year, chaired by the Treasury and the principal financial regulators, put out, in which the Fed participates, put out a white paper at the end of last year on money market fund reform. The FSB is going to be putting out a consultation report in the middle of the summer on proposals for money market fund reform with a final paper due in October at the time of the G20 summit. In general, non-bank financial intermediation is the subject for the FSB this year. I think that that's one of the lessons learned from the financial crisis as well, is that all of the capital that we put into banks, the changes, the reform to bank regulation post the financial crisis, did create a more resilient system. There were areas in non-bank financial intermediation where that resilience wasn't as apparent. I think there's also a general understanding at the FSB, certainly it's my view, that you can't say, okay, what we did for the banks worked pretty well in a very significant stress. We need to take kind of the same tools or measures and apply them more athletically to non-bank finance. And by that, I mean, okay, well, let's put a whole lot more capital into everything, a whole lot more liquidity, those measures, because I think we have to recognize that, non-bank financial intermediation resilience was not as robust as we wanted it to be in March and April of last year. But the non-bank financial system just operates in a wholly different way. There aren't the same reliance on sort of very large, systemically consequential institutions at the center of a larger institution. Non-bank finance is, much more dissipated, much more diverse, and therefore the resiliency measures will likely need to be different. So we're focused on that at the FSB and understanding what those ought to be and what measures we ought to take. Of particular relevance to your participants here today, I think, margining practices during the crisis. There are a number of folks, particularly the Europeans, but even more broadly at the FSB, the central clearing counterparties worked well. But I do think we have to look back and say, well, the effects of margin calls during the period of stress may have been procyclical. Now, that may be just a necessary feature of the system, but it may be something that we can think about how would one adjust the system to try to address that procyclicality. So we will be giving attention to that over the course of the next year, to the effects of margining practices during stress. And then less related to lessons learned from the crisis, but a couple of other very important matters that we're dealing with at the FSB. One, the payment system in general. And the speed and efficiency of payments, and particularly cross-border payments. And there we're working with the Committee on Payments and Markets Infrastructures of the Bank for International Settlements we've laid out a roadmap, and now we're working on implementing elements of the roadmap as to how to improve that cross-border payment system. And climate issues and the potential effects on the financial system will be an area of focus for the FSB.
Great, yeah, thank you. And I especially appreciate your comments on procyclicality. That's been an issue that we at OCC have focused on significantly in terms of improving our methodologies in terms of transparency, in terms of predictability, but also in terms of reducing procyclicality effects. So your comments are greatly appreciated there. I wonder if you might also just characterize the collaboration and cooperation that you see between and among FSB participants.
So I would say that it's the degree of the degree of interaction. There's if you look at the general schedule with all of the subcommittees and working groups, and then the general steering and plenary committees, and the committees we sent up to deal with non-bank finance, and there's probably an FSB meeting of some sort every day of the year, and the level, so the volume of cooperation has been staggering. The quality of the cooperation, I'd say, has been quite good as well. There's there's a real desire to fulfill the mission of the FSB, which is to ensure that there is global financial stability. There's relatively little. You can't avoid it entirely in these international meetings like this, but there's relatively little folks retreating to the corners of their sort of purely parochial concerns and trying to defend those parochial concerns, as opposed to really understanding the position of the various other members. I think that if the folks listening here could participate in the FSB process for a month or two, you'd come away quite impressed. I certainly have been very impressed with the quality and collegiality and usefulness of the cooperation.
I know we're limited.
One of the things I should mention that's probably a particular interest to the folks today is that one of those areas where we are focusing and where we have that level of cooperation is on sort of CCP resiliency and resolution in particular. I think one of the issues that remains unfinished was not a problem during last year, but that, going back to the earlier comment I made of thinking of, well, what might have happened that we aren't certain we would have been prepared for had it happened. The CCPs performed really quite well, but if there had been a rake stepped on there, I think at the FSB we've said, so what more do we need to do to ensure we would have been prepared for that had that happened? Because we were pretty lucky that didn't happen. But it wasn't entirely luck because we had a very robust infrastructure, as I said. But nonetheless, had that happened. So I pulled together a smallish group to focus on that question in particular, and the willingness of very senior people around the world to come together in groups like that under the aegis of the FSB to address questions like this, is another example of what I think is the quality of the cooperation there.
When you've talked about the FSB, you've described there being very little margin for error, and that many of the objectives that you have require a very careful balancing of, diplomacy on the one hand, and rigorous analysis on the other hand. I wonder if you could just share with the audience a little bit, what have you found are the most important aspects you have to bring into your analysis and decision making to get it right?
Well, I think maybe the foundational. There are a number of important elements, I'd say, to that question of how do you sort of coordinate a large policy process like that to get a useful outcome, and I think transparency has to be probably foundational. Transparency, which the FSB hasn't, it's always been something that it has tried to do, but I think it has improved its transparency over the course of the last few years. And I think that's beneficial. The more that we are transparent with the public about what we're working on, the more that we go out for consultation early in the process before all the positions have sort of ossified around a policy question, and gotten input about that, and triggered voluntary input again by being open about what our agenda is. 3 years ago, I think, was the first time we published our agenda for the year. So the more that we can do that, I think the better the outcome will be. The more that we can ensure that we're getting a broad variety of perspectives around the table. And the FSB is designed to do that. But there have been some times where there are institutions or even jurisdictions that are not members of the FSB formally, but we have brought them in to help us address one issue or another because it's clearly the right expertise and its perspective that's not otherwise going to be addressed in the formal membership. So to ensure that you've got that diversity of viewpoints and that your processes really allow those diversities of view to be heard is very important in getting to the right answer. And then being sort of very clear and consistent about what your objectives are, trying to avoid mission creep, right? The financial stability is going to focus on financial stability, and there are broader issues that may be important and that we may look at from the financial stability lens, but we should not sort of morph ourselves into philosopher kings, trying to move the world in the correct direction, but focus, kind of very clearly and laser-like on ensuring that our financial stability mandate is maintained. And I think if we do those things, transparency, diversity, clear focus on the mission, I think that's key in any sort of an organization in getting the right answer to a complex question.
Yeah, thank you. Do you have time for just one more quick question? I know we're getting to the end of our session. We have one or two questions actually from our audience participants, and one is just, looking back over the last year, what do you think are some of the more interesting developments in financial markets that we need to be thinking about carefully from a supervisory perspective?
So from a supervisory perspective, I guess maybe one of the more interesting developments are developments related to stable coins, digital currencies generally. I think that's something that we need to give careful thought to. I think that on those issues in general, and people have had a lot of other things to think about over the course of the last year as these issues have been rising in salience. And so I understand why I think the depth of consideration that has been given to a lot of policy talk around those issues hasn't been as robust as I would like it to be. I think over the course of the next year or two, really thinking carefully about the issues that are presented by stable coins, the broader question of digital currencies, what we're trying to achieve, what's already done. I think that's probably an interesting topic, and fintech generally. Obviously, the pandemic over the course of last year has focused a lot of attention on simply responding to that, but the inexorable march of technology is a huge opportunity but also a supervisory challenge for the financial system.
Yeah. Well, thank you very much. On behalf of not just my colleagues at OCC, but the entire options industry and our audience participants today, Really want to thank you, Vice Chairman Quarles, for being with us. And I also just want to say very sincerely, we're really fortunate to have you at the helm in the roles that you're in right now. And you've been terrific to work for, and really always very open-minded and willing to meet with the industry and understand from a practitioner perspective, the things that we're trying to deal with. And so we thank you for that. We thank you for your leadership, and thank you very much for taking the time to be with us today.
Thanks for having me today.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.